Hey everybody, welcome to our Foxenomics chat. Thanks for coming. Happy first day of summer. It's the longest day of the year. Although for those of us holding crypto, Saturday felt like probably a longer day. Um, but yeah, hope everybody is having a good summer. So yeah, this is just another another cycle we're experiencing. I think the fact that we are having a bear market does not come as a surprise. We've been planning for that at the DAO, but I think one thing that was surprising is the sheer ferocity of the selling over the past week and a half or so. I mean, I've been watching crypto for a while, and I've rarely seen prices unwind like that. We just had these cascading liquidations. You had big firms, basically going out of business because they didn't employ basic risk management, and they got cocky. They got sucked into the whole degen thing, and they made mistakes. This has been repeated many times in the TradFi world, and we're in crypto. Many firms, or at least some entities, are repeating the same mistakes, and not doing basic things to manage risk. And we saw a lot of this in the 2008 meltdown too in TradFi. But the good news is here at ShapeShift, we do employ basic risk management, and we're not doing retarded things with our money. That said, we definitely are not invincible in this environment. We are a DAO with not yet a ton of traction, and arguably not yet we don't have the product market fit we need yet, and we do have a limited runway. But in my mind, it's like this is actually a really good time to build, because we can just kind of get lean and mean and focus, and it's also a good time to kind of second guess, previously held assumptions. Like, okay, we don't have to. We're not really sacrificing a lot by kind of taking a look at where we're at, and perhaps pivoting in certain areas if we want to, if it makes sense, because it's not like we have this amazing proven out thing already. So this is a great time to build, and of course we have Fox Chain, we have this great platform, and some great business models around it. So given all that, where are we at with our treasury in terms of our runway? So right now, if you add up what we have in our treasury, what we have in our Olympus USDC to ETH bond in that contract, and then also in Colony for what's actually a surplus in the various work streams and not being spent for June payroll, we're at about 4.36 million. And then if you consider, so the next component of this is, as you guys may have seen, we're undergoing some budget reductions, and there's no like fancy, buzzwordy way to put it. Like these are salaries getting reduced or potentially positions getting eliminated, and it's hard to sugarcoat it. It does suck. So you guys may have seen recently. DeFi Cafe had to let multiple engineers go. Some of these were ShapeShift OGs who really, these are people who really made a big difference. And I know that was certainly not a easy decision for him to make. And I know some other workstream leaders are considering or weighing, cuts as well. It's not great, but it's also kind of essential for us to do this, because if we're not cutting the budget, then we're in a position where maybe we get lucky, maybe this bear market turns around, and then by say late Q4, early Q1, it's back to up only, and hey, the party's back on. But historically, that granted, there's a limited sample size in crypto, but historically that hasn't happened. If we use the last downturn in crypto as an example, that was like a 2-year bear market. It was ugly, and it was long. It was a real slog. So the prudent thing to do is to plan for a longer bear market. Originally the goal was to focus or to target a runway of 18 months. I think that's still a good goal to aim for. Currently, and I'll be sharing a more detailed spreadsheet soon after getting some more info from workstream leaders. But if you factor in the expected budget cuts, we have, along with our expenses related to debt service, and specifically those expenses are, let me bring up the spreadsheet here. Those expenses are related to RARI. We're paying about $85,000 a month in pool 7, and this is just a guesstimate, but it's going to be around just $1,000 in pool 79. I'm not sure what the exact figure is, but it's pretty minimal. And then we'll be paying some interest as well related to our liquidity as a service arrangement with Tribe. That should tentatively that should be about $6,000. That's not set in stone yet. But if you factor in our total spend, the various work streams, along with our expenses related to that debt, we have currently about 10 months of runway. And that puts us out to April of 23. So, that certainly is better than a lot of projects. One thing I've been doing whenever I'm looking at DAOs, how are they doing? Out of curiosity, in some cases thinking, hey, maybe this could even be a good investment here in this bear market, is looking at their treasuries. Some treasuries are in a very similar position as us. Some are still holding kind of like their own native token, which is a very risky proposition unless it has a good market cap, because these tokens go up and down with Bitcoin and ETH, and often go down even faster, as we've seen with Fox. So really the goal here is to stretch that further, but we certainly have some immediate runway here. As always, I want to caveat this with what I'm talking about now represents the worst case scenario, and then in that it does not include any revenue, and it does not include any income from our bonds or any other sort of stable coin income. That's actually a little bit, given current market conditions, that's not quite accurate, because even with our reduced emissions on the USDC to Fox bond, we're bringing in, I believe, about 25. I just kind of eyeballed it, but it's about 25K a week. So, that's 100K a month if that keeps up, and that will offset our debt payments, and that's nothing to sneeze at. That alone could extend our runway by our month or two as we move out here on the time frame. And the TMDC chat we just had, we were also discussing other ways to increase that stable stack. One idea would be if we have a sort of lasting bounce in the price of Fox, we might want to temporarily increase our emissions to bring in more stables while the price is relatively high. We could also try another hedgy bond. Our previous effort was kind of put out there right before the market really went down. So we're talking about potentially trying a more modest bond that could still make a difference to our runway, something like 100K. The challenge there is it's questionable again whether or not there would be sufficient demand, but we might be able to tweak the terms such that there is. There's also Porter we've talked about. It makes sense to think about the worst case scenario. You don't want to assume anything. And if you look at where the market is trending, it's not in a good direction. Of course, we had this oversold bounce. There is maybe a small chance that this really was the bottom for crypto. We put in a V here. Maybe the next inflation data that comes out, I think it's around like July 10th. Maybe that reading is actually somehow lower than expected, and maybe all of a sudden the Fed is taking a more moderate approach. But there's that saying in the market that's been around for a while, is don't fight the Fed. And right now the Fed is creating a very difficult environment for risk-off assets, or I should say risk-on assets, and actually pretty much everything else, thanks to this inflation. So that's kind of where we're at in terms of just our general runway. If somebody wouldn't mind, actually I can grab it here. I'm going to post the treasury asset spreadsheet that Darwin maintains. So you can always refer to that. This guy is updated as of this morning. Let's see here. Anything else in the chat? So yeah, that's what we're looking at right now. A couple of TMDC updates. And there's one here. One I'm really first thing I'm actually really excited to talk about, because it was a kind of a fun exercise in decentralized governance, and also just kind of like, you know, encountering an edge case that was really interesting to deal with. So last week, pardon me, last week, as the market continued to go down, it occurred to me that, like, hey, maybe I'm kind of looking at our spreadsheet and looking at this wrapped ETH that's sitting there and thinking, well, okay, that represents value that we could actually harvest now and put in our stable stack. The logic there is, of course, we want diversification, not only in stables, but also crypto. All things considered, it would be nice to have more ETH on our balance sheet. However, getting those in hand now, or converting those to stables, is a good move if the market continues to go down. Alternatively, if we've hit a bottom and we just rocket off these lows, and it turns out we don't have a long bear market, well, yes, maybe ETH goes to 10K, and that 325 wrapped ETH is worth a lot more. But in that case, Fox very likely will have rocketed off the lows as well, and we won't be in such dire straits. Whereas if we continue to decline, we really need that wrapped ETH. So kind of talked about this with the TMDC a little bit, and then we put that up for vote, converting that wrapped ETH to USDC, and that passed. However, then members of the bond committee pointed out that, hey, actually that wrapped ETH was intended for use in our liquidity mining programs, and that this is actually not the purpose of the wrapped ETH. So what followed was a really good discussion kind of about the nuances of, like, well, does this, if we were to sell this wrapped ETH, does it, kind of, would it really interfere with the liquidity mining program that had been approved, but also does it go against the language of it? So the bond committee themselves wound up discussing this, and they had a very narrow vote, barely, I think it was 3-2 in favor of selling. So this almost didn't go through. But it was really cool just to see some good vibrant discussions around this. Props especially to Ron and to NeverWas for lending their thoughts on this one. I think that those that were in favor, or those against selling the ETH had a good case as well, and it was just exciting to me to see some good discussion and debate around this, as opposed to, like, most things are relatively non-controversial. Pardon me, I'm just going to have some water here. Talk amongst yourselves. Okay, so what the original thought with that $325,000, or it came out to about 323K, was just to put it into our stable stack, extend our runway. So on Saturday morning, the market is tanking really hard, and we're looking at the price of Fox. So, again, one of the things that you need to understand with respect to our Rari loans is that it's very, very important that we maintain a liquidation price, or that those loans don't get liquidated, because in that case, we lose all that Fox. People or bots will probably buy it and sell it, and it would be a epic clusterfuck. You guys have seen what happens with liquidations and other projects and entities. It gets really ugly. So just being mindful of that. We actually have a TMDC vote that kicks in, or that's actually pre-authorized the multi-sig users, or multi-sig holders, to add more collateral if we approach those liquidation prices within a certain level. So upon kind of getting close to that level on Saturday, we were taking a look at our two pools, seeing where we're at in terms of liquidation prices. Doing so, we came to realize that 500,000 FEI, or which had been converted from USDC in our stable stack, had been erroneously applied to pool 79 instead of pool 7. Pool 7 is the one that we want to pay down because there's more in there and it has a much higher APY. Thus, it costs us more to maintain. So this was, and I think it's very important to bring this up in the spirit of transparency. In this sense, we had an error. we misapplied funds to the wrong loan. The fortunate thing is it's not like these funds were sent off to space. They did pay down our pool 79 loan, which actually allowed us to pull out some collateral from that loan, put that into pool 7 in order to bring down that liquidation price. And then we also then the 323,000 that we intended to put into our stable stack and just for keep that for future expenses, we took that amount and then we put that directly into the loan. That was not the original intent of that money, but this was sort of a direct response to our realization that those funds were misapplied. So this was, I think it kind of just speaks to the confusion that can arise with this multi-sig setup we have. I think there's a lot of room for improvement and more decentralization. Willie, if you wouldn't mind just speaking to this one a little bit, I think because it does get kind of confusing.
Yeah, no, I'm happy to, and I want to speak to it because I really want to just apologize to the community and accept full responsibility for the mistake. I'm really grateful it wasn't a mistake that resulted in a loss of funds. To John's point, like if borrowing was online on Rari, we would have just been able to reborrow and then pay the loan back on the correct pool. And the reason that this happened, it wasn't that we were careless. It's like Ken said, is really the complexity of setting these up, and it's basically just so you guys know. Yeah, we set this up in a way where we had to kind of proactively anticipate all the transactions in order to get it done quickly. So like when you don't have Fei yet in the treasury, you can't use any of these user interfaces. You can't use Rari's user interface to basically set up these transactions. So we were doing a lot of transactions on the contract level, basically doing the swap, approving the spend of Fei, and paying back the loan. And always try to use like our address book or past transactions that we've executed to make sure we're getting the right contract address. And so basically this one was an easy mistake to make, but a really hard one to catch when verifying the transaction. So I take responsibility for making the mistake. These contracts look identical, but the only difference is just the name of the token, and it's like a very, very long name, and most of the token name is identical, and it's just one small piece that's different in the whole contract. So basically that led to setting up the transaction to pay back the wrong loan, and then was very hard to catch that in verifying. So it got executed, and then realized after it was executed the mistake we had made, and was just so devastated. There's a lot of responsibility with this, and I don't take it lightly, and I feel really bad making these mistakes. So I'm just grateful it wasn't a mistake that resulted in loss of funds, and hopeful that Rari borrowing will come back, so this can really be a non-issue. But yeah, in the meantime, just being extra careful, learning lessons with each of these transactions to help make sure that we're verifying even more diligently and not making mistakes until we can evolve past this multi-sig. And yeah, we've done about 500 transactions on the DAO treasury, and we've had 2 mistakes. So still very, very low mistake rate, but we need to get it down even lower. And yeah, just want to apologize again to you all and commit to being extra careful. On the bright side, these mistakes make it, they're lessons, and they make us even more careful with every future transaction that we do execute.
Thanks for the postmortem on that, Willie. And yeah, we are in good company having encountered one of these situations with many other DAOs and projects. And like you were saying, I mean, this can happen. This has happened to a lot of projects. I think there was Optimism, it was Wintermute, I think, over on the Optimism side. There was some very recent mistake there in terms of sending to like a mainnet instead of a layer 2 address or something like that. And these things have happened a lot. I think back to of course, it was more of a contract bug, but Parity had all their funds locked up in the Parity multi-sig hack. So, this is the environment we operate in. But yeah, I think we will become more anti-fragile by virtue of this. And it's certainly it's in the scheme of things, it's an error that it's really, it's something that is not a flesh wound. And it really is kind of nice to pay down that money anyway. That is money we owe in that loan. So we're going to make it. But yeah, wanted to make sure to be very transparent with the community on this one because these are the community funds. But again, this is not a make or break, and it's a lesson we're going to carry through this bear market and become more anti-fragile. Does anybody have any, let's see, before I go in the next one. Yeah, and great point, Ocean. I mean, the multi-sig signers, Willie, you said 500 transactions. That's a lot of stuff. And it really speaks to the need to have a more decentralized multi-sig. Of course, having more multi-sigs or a more decentralized process, it's just good for decentralization, of course, but anything that can just sort of take that pressure off a little bit. These are humans at work here, not crypto robots or AIs. Yeah, coordination is a challenge. I don't actually know of any easy answers right now, but I feel like this is one of those that falls under the banner of like progressive decentralization, for sure. Let's see. Hedgehood said he wants to talk about Hedgy or Yieldy. Yeah, we'll be covering that. Let's see here. That's actually the next topic. So Yieldy, you guys will remember, is the general application version of Foxy. Foxy, of course, is just for Fox. It's a way to easily earn yield by staking your Fox and holding Foxy. Yieldies are a financial primitive that can really be for pretty much any ERC20 that can be used for yield generation in the DeFi world. The first choices, most obvious choices, would be like ETH and USDC. So this one I just moved to ideation from draft. It seemed like it generally got support in the draft phase, but I think it's like an elegant sort of use of that Foxy technology. It also has a important characteristic that it can redirect a certain amount of profits back to the DAO, so directly benefiting the DAO. As it's written, that fee is 10%. That I kind of floated that number in the first in the draft phase. That seemed to generally have support, and it feels like a fair amount for the DAO to get back. Of course, we can do all manner of things with that 10% fee. We could then put that back into our stable stack. We could put that back into the staking contract. There's all sorts of uses, but basically that would be revenue for us. DeFi revenue kind of feels like something that's far away right now because we're in this bear market, but things will pick up again, and this is a great tool to have and a unique one that I'm not aware of existing elsewhere. So yeah, that is currently in ideation. That'll be moved to the formal governance phase in a few days if all goes well. Hedgehood, I see you in the audience. I don't know if you're around, but if you are, you mentioned Yieldies. If not, if you still stepped out, I can just bring you up again at the end of this chat. Cool. One other item is June 30th is quickly approaching. That is the end of the current phase for the tokenomics workstream. This is a 3-month period we're in right now. So be on the lookout for a proposal outlining the next 6 months. I'll be moving that, or I'll be creating a draft of that soon. Just like last time, kind of doing a quick little review of where we're at, what we did, what were our goals, what did we, where did we meet our goals, where did we fall short, and then kind of just laying out the budget and things like that for the following 6-month period. So be on the lookout for that. Gosh, this has been a fast one. It's not even 4:30 yet, and we've made it through the agenda. I'm curious to see what Hedgehood has to say whenever he's back. But in the meantime, does anybody want to come up and chat about anything? Any questions in the chat? I guess I can just riff then a little bit. So, one cool thing, I don't know those of you who actually like to, who invest in crypto, whether you have $100 or $1,000 or $10,000, bear markets can actually be really cool for buying tokens at very low prices. Of course, it's a matter of timing, but I've really, like, I have a little bit of dry powder. I've been looking at, like, okay, things are really down right now. What potentially is a good buy? What other projects are like Fox that have good long-term prospects, but their tokens are down. So like I mentioned, one of the things I always do is look at the treasury, see how they're doing. I think a lot of projects will probably blow up because they didn't employ basic risk management and they didn't diversify properly. Others that rely on unsustainable liquidity mining might be in the same boat. I think in this next market, liquidity mining will kind of feel like this anachronism, like a throwback to the last cycle, almost like how ICOs felt this cycle. It's like, okay, liquidity mining serves its purpose. Of course, we still do it at ShapeShift, but over time, it's certainly our goal to get more protocol-owned liquidity and wind that down. There's more sustainable ways to do things. That's always a good thing to take a look at, is like, what are the business models looking like? Also, take a look at like how the founders are and the main people in the project, how are they reacting to the bear market? If they're getting defensive, a little bit asshole-ish on Twitter or whatever, you see them getting defensive, it's usually kind of a sign that they have something to hide. Maybe things aren't going well. But if they're adapting to this market with grace and with sort of calmness and a plan to move forward and not freaking out, that's a good sign. Because these markets, in a way, like, even though it sucks, there's a positive side of like just being able to focus and build. Of course, you can also look at the technical levels. Like I used to be a technical analyst way back in the day, looking at stock charts and writing about it. And even though TA is not like a guaranteed lead pipe cinch that something will happen, I tend to find that, like, the market does really congregate around very important support or resistance levels, and it kind of helps you guide your decisions a little bit. So even though you wouldn't want to, like, bet the farm on something on a technical sort of standpoint, it can certainly help you, like, fine tune entry and exit points. Let's see here. I'm getting pinged in the chat. Any plans? Tyler, great question with the respect to VFox. VFox, the way that proposal worked is VFox was allocated up to $1 million in funding, basically pre-approved to spend on various things. We had our first initiative, or our first investment into Elastic Swap a few weeks ago. I think that's going to bear fruit, a really good win-win for both projects. So we're currently looking at some other ideas, maybe even like super closely at one idea in particular. However, we can't be too aggressive in this environment. So I would say that to your question, Tyler, in response to these changing market conditions, we've had to maybe scale back our plans to deploy that capital, we have to be very mindful of our stable stack. So, we can't just YOLO into like, let's throw, like 200K at this deal. But that said, I think there's still certainly a case to be made for making smaller investments in different things, because say even 50K in a project that's very promising, in crypto 100x's are not unheard of. 50x, even a 10x is cool. So that will be I think it's probably, actually, now that I think of it, it's probably a good time to provide an update on VFox within the next week or two, and give you guys a sense of what we've been looking at. One of the things that I'm excited to do with VFox is sort of build out a nice diversified portfolio that gives us exposure in the DAO to various things. Of course, with Elastic Swap, we have a very unique, one of a kind type of AMM. When you look at other verticals, there's everything from NFTs to gaming to layer twos, roll-ups, bridges. There's like so many cool things to potentially allocate funds to. So that's something we'll be taking a look at. But also being very mindful of the fact that this is there's no rush. This is a bear market that will probably last a while. And there's a great old school analogy in the stock market that applies here. Is the analogy is like, the market is sort of like a pitching machine in baseball. It keeps on pitching, and you don't need to swing at everything. And if you don't swing, inevitably there'll be another opportunity coming down the pike. So, we're just employing our due diligence, being very and I would say being super picky about, what we even really choose to spend time looking at more closely. Mr. Hedgehood, let's see if you're back. Not yet. Okay. Yeah. So, what else is going on? We had a really cool chat about Foxchain today with the Coinbase Cloud team. Foxchain is still in its formative stages, but is already getting more momentum. And this, I think, like, it is such a powerful piece of like our long-term growth opportunities, because really it's a one-of-a-kind thing, kind of having this decentralized node infrastructure that is tied into some crypto economic incentives. So, specific things we're looking at right now with Foxchain are, okay, if we're going to do an entirely new token, perhaps like it looks likely this will be in the Cosmos ecosystem. So a new token for a new zone, who gets that token? So, okay, if we're going to airdrop that, what does that look like? The Fox airdrop and Fairdrop, I think, were met with a lot of enthusiasm. I believe the Fox airdrop was the most widespread ever in crypto, because we're able to drop to all these users. The Fairdrop included DAO users of other excellent DAOs like Giveth, and the idea with an airdrop is you really want a lot of people to have a vested interest in what's happening. So who gets those airdrops, and then how do we allocate those funds are some big high-level questions. We've seen many instances, both the last market and this market, where people hate basically tokenomics where there's a lot of insider allocation. We've seen this a lot with VCs. Your classic VC token where they got into the seed round and then they basically dump on retail. I mean, that's happened countless times, and people hate that shit. So we certainly won't be employing that. I don't think there'll be any sort of insider allocation. That said, there needs to be some sort of, the model needs to benefit the DAO in some way. The DAO is taking on the, I don't want to say burden because it sounds like a bummer of a term, but like the DAO is doing a lot of the heavy lifting and is also kind of come up with this idea. So we need to balance things out such that the token is fairly distributed, but the DAO also gets a a stake in the project's success. So again, we're early on with this. There's a lot of technical things that have to be defined, but it's going to be really cool to see that shape up. Okay, Hedgehood is back. Let me get you on the stage. All right, you should be able to jump up if you can. GK or anybody else who's a mod, would you mind trying to get Hedgehood up here? He's I'm trying to get him up. It's like there's a line of bouncers in front of the stage, and they're not letting him up. But we want to get him up on stage. There's GK.
He has the thing. He just has to accept it.
Okay, he just put his hand up. Okay, so maybe he's actually not back yet. Maybe that's what's going on. How are things in Modland, GK?
At the moment, pretty quiet, but it's been kind of crazy last few. You just never know. Not as exciting as the Foxenomics.
I can stall for a second. We can talk about these this Prime deals.
Oh yeah. We actually didn't get a chance to really cover this in the TMDC. So DAO to DAO token swaps. Yeah, please enlighten us on this one, Willie.
Yeah, I had the pleasure of talking with Prime deals today. They're pretty cool. If you guys aren't familiar with Prime DAO, they also just did they have these Prime ratings, and they did a rating on ShapeShift recently. We're currently number 18 DAO on their list, with room to improve as we execute on our roadmap. And so Prime is really focused on their token is D2D, so they're really focused on these DAO to DAO relationships. And they recently launched a new offering called Prime Deals. And the whole purpose is to make it easy to initiate and negotiate and execute token swaps with other DAOs. And they've got a couple DAOs that are already using it right now: Olympus DAO, Giveth DAO, Cello, Bankless DAO, Balancer DAO, and of course they're using it themselves: Prime DAO, Fiat DAO. And it's pretty cool. Basically, one of the things we can do here is we can put together a kind of token swap proposal template and post an open proposal, and basically just make it easy for other DAOs to kind of make an offer to us for a token swap. And then we can choose what our template looks like what questions we want to ask them, any kind of requirements we want to put in there. So if we want to require that they hold the token for a certain amount of time, or if we want to require, for instance, that all the tokens get paired with their token and provided to a liquidity pool for protocol-owned liquidity, we can totally customize that. So I know we're going to talk about this more with the Team DC on Thursday. Prime DAO has said that if we want to put up if we do put up an open offer, they'll make an offer to us for a token swap. And really, we can kind of just leave this open, or we can also kind of do outreach to some of the projects that are already using it, or projects that haven't even used Prime DAO before, and let them know that we're open for token swap offers. So yeah, I think this is pretty cool. It's a great way to build these DAO to DAO relationships, and it's a great way for us to get more liquidity in a way that doesn't have any ongoing cost to the DAO. So we're basically diversifying our treasury, and we can end up with protocol-owned liquidity, and create relationships with DAOs that we want to align interests with.
So from a practical standpoint, Willie, would we sort of would we pre-approve a certain amount that we wanted to sell? Like specifically the TMDC might be like, okay, we're okay with selling XYZ, or I guess that could happen via governance as well. But then we create a Prime DAO offering saying, hey, we're open to swapping up to XYZ with any counterparty that we as a community agree is a good deal.
Exactly. I think that's a good way to approach it. It could be within the TMDC's purview, but I think that this would make sense to create kind of a new proposal that allocates a specific amount of Fox that would be, a max amount of Fox that would be open to using for these token swaps and for providing liquidity. Kind of figure out what our template would look like there for what information we'd like to request from these from these DAOs. But yeah, I think it makes sense for this to be its own proposal to set aside an allocation of Fox. The community wants to, and then we would want to appoint some representatives, and I think the representatives could be the TMDC members, and they would basically be the ones who are delegating the authority to basically negotiate and actually decide whether or not we want to approve or execute these each one of these token swap deals that come from it.
And does Prime actually facilitate the actual transaction in the sense that like they're escrowing the funds in a smart contract, or is it more so just like they're creating the mechanism by which two DAOs can come together and then they just execute the swaps like sort of on an atomic basis with each other?
Great question. So yeah, that they've built contracts and a really nice UI for actually escrowing the funds. So basically the way it works is once both sides have approved the deal, then you can start the funding period, which we can configure. They recommend 14 days. And then during that 14-day funding period, both DAOs can deposit their tokens. Let's say like DAO A deposits their token and DAO B doesn't. DAO A would also be able to withdraw their tokens. Then once both tokens are deposited, anyone can actually execute this transaction to transfer the tokens to either DAO. They don't yet have the ability to execute the whole liquidity providing and then like send LP tokens to both DAOs. But I let them know that would be a really cool feature, and it's on their roadmap. So for now, if we wanted to do the liquidity providing, that would have to be done manually by each DAO. But yeah, they do handle the escrow, which is pretty cool because in the past, most of these token swaps require setting up like a one-time multi-sig with signers from both projects to facilitate the swap. And they do charge a fee for it. There is a 0.3% fee of each token swap. So that is the major downside. But they share 50% with the proposal lead. So we could basically if we wanted to, we could get half of that right back into the DAO treasury. And then also another quarter of that gets paid to the DAO in D2D tokens. So really it's like whatever 25% of 0.3 is what we're actually, it's 0.075% fee that we would lose for each of these token swaps that we execute through Prime DAO.
This is super exciting because it sort of basically creates like, I don't know if secondary market is the right term, but kind of a nice niche market for this specific need of DAO to DAO swaps. Like doing this manually can be really challenging because you have to approach the teams and then they have to go through the governance processes and there's a lot of friction with that. It's kind of time consuming, but you can kind of imagine a scenario where when many DAOs are using Prime, if that happens, it'll be a lot easier just because some of the friction's taken away, both in terms of the logistics, but also like, if the DAO's respective treasuries have pre-approved this, then it's like not having to go through necessarily the governance process. And yeah, I'm super excited to kind of see how this one shapes up and maybe position ourselves to use it.
Awesome. Thanks for giving me some stage time. Looking forward to talking about this with the team DC, and if they're on board moving forward with the proposal for this. But I see we got Headshot up here, and I also saw Ocean posted a good question in stage chat. So yeah. I'll hand the mic back to you guys.
Cool. Thanks for the info, Willie. Yes, we have Headshot up here, talked about yieldies. And then after that, thank you very much, Professor McCarthy, for bringing up Bancor. We're going to be chatting about that because there have been some meaningful developments about that impact our liquidity mining strategy as laid out in the most recent proposal. But first off, welcome back again, Mr. Headshot.
Hi, hey, good. Sorry about earlier. I sent a message. I had to drop off for a minute. But I was liking the chat, everything you're saying about Yieldy, and I want to just share maybe some insights, things I've heard in the space that might be an interesting way to explore how Yieldy could be used. You can hear me okay, right? I'm not talking to myself?
Yeah, loud and clear.
Yeah, cool. So we've been talking with a lot of DAOs who have either ETH or USDC, who are somewhat diversified, and they're trying to generate yield on these assets. And one of the major friction points we see is one, like the kind of complexity of deploying it to yield strategies, whether it's like going into different protocols or multiple protocols, or forget like even trying to farm with it. And so a lot of DAOs are trying to find ways to have something that doesn't involve like either giving these assets to a multi-signator to execute strategies, or even, you know, like just trying to create something that's very simple and just generating yield on idle assets. And I feel like we're literally having conversations with DAOs who are trying to deploy these strategies, and we haven't seen a product yet that really like nails everything. And one of the things I was kind of perked my interest was this seems like a very, like, I think you mentioned it, like a set it and forget it approach to generating yield on idle assets. So I know I missed a lot of the conversation, but that was the thing that kind of caught my attention. And so I just wanted to share that I am seeing signaling from the market that this is something people are very interested in, like a simple way for DAO Treasury to generate yield on assets like this.
That is super validating to hear, because you're very dialed into that segment of the market as well, and you know, specifically with DAOs being very mindful of their treasuries. It's easy to imagine a scenario once yieldies are live where there's, you know, definitely some overlapping of interests here with specifically what you guys are doing. Maybe, you know, like you could kind of put hedges in front of DAOs that might otherwise be unaware of them, and you know, we could work out all sorts of cool sort of arrangements. But just that data point is really really good to hear.
Yeah,
Especially in this
yeah,
market too.
yeah. Not even like hedgy related. You know, I think I just like now that I'm in these calls and I hear what you're all doing, like I really like seeing products like this because, like, yeah, like there's just DAOs that aren't in your ecosystem that they're looking for something like this. So yeah, in this market, it's interesting. I think there's a few areas that people are exploring for their treasuries, but this is definitely one. I mean, I was on a call today with the DAO that they have, you know, 2 million in ETH, and they're trying to generate some type of yield on it. And there's just a lot of friction points. Maybe on another call, I could dive into like a few of the nuances or specifics there, but like I think this is a really interesting opportunity, not just for a DAO like them, but like just people who are trying to generate yield in a simple way. So,
Awesome.
there you go. That's it.
Yeah.
That's all I had.
And then the challenge, or I think the interesting thing to see coming, you know, I guess as we move forward, I don't know for how long we'll be in this market, but like the number of strategies that one can employ to earn yield is sort of limited right now. You know, like tokamak is what we're using for Foxy, but of course those rewards have been reduced. So it'll be interesting to you know, just see how DeFi evolves and where new strategies emerge. But I think the
Yeah.
cool thing is, regardless of what those strategies are, the basic value prop of yieldies remains the same in terms of that set it or forget it sort of thing, because that to the user, that's all taken care of.
Yeah. Very important for a lot of DAOs. Like that one value prop is very important. It's a roadblock for many DAOs making a decision to generate yield, is that they can't just set it and forget it. So happy to
Absolutely.
talk about that more later. Okay.
Hey, as long as I got you up here, quick question. So in the TMDC chat, we were just talking about perhaps, you know, maybe we could issue another hedgy offering. Our first one, you know, was timed right before the market collapsed. It didn't have any real counterparties. The thought was maybe we do like a more modest offering, something like 100K, maybe offer a more favorable discount. But there's still some concern about like, would there be, like in this market, is it almost like a waste of time to do that? Would there be any sort of demand on the other side? Do you have any general like advice for? Have you seen
Yeah, I
projects
mean,
that drum up enough demand for hedgies?
we've actually been talking about this a bit because like I really think there's not one tool for like diversifying assets that is a perfect solution for every condition of the market. There's this. I'll get back to OTC in a second, but there's this tool we created when we first launched Hedgy, which was our first diversification product, and it's DAO selling covered calls with their native tokens. And it's complex. I know I say that and like it washes over a lot of people, but like OneHive used this, and it's great for conditions when you're not peak bull because it lets you set a higher price point at which Fox converts to a sale, but it also lets a DAO generate stable coins before there's any token sale. Like I could go into more detail, but I think OTC is an interesting product. I've also seen OneHive successfully diversify or build some stablecoin reserves just by writing covered calls, which I actually think when a market has like seen a retraction of 80%, if you write long dated covered calls, it's yes, more complex, but it's a very appealing product for both DAOs and buyers. Because it's just different. It's like basically like leverage exposure on the upside that benefits a DAO and the buyer. So that's more than you asked, but I think like OTC is something that is definitely maybe appealing. And I also think like we've been talking with some DAOs now that the markets are down on covered calls. That's actually an interesting product as well. And if there's any interest, I could explain it more another time.
Yeah, I mean, we are not dialed into any specific tool. I think really any tool that that is reliable, secure, and really can aptly fit the current market environment is great. So that's something we're digging into more. Yeah, we could probably for sure have you back for another session, maybe like for a special TMDC chat around all this or something.
Yes, whatever helps. I mean, I could show you some case studies from OneHive, but they generate some stable coins in a really cool way that it was like a win-win for both sides. So happy to chat about that for sure.
Awesome. Yeah, we'll certainly be in touch on that one. Thanks for the insights as always.
Yeah, of course. And and I just got a message from Willie about the contributor awards getting executed as well. I think that's awesome as well. It's like seems like things are rolling. That's great.
Yeah, that's another like super cool use of Hedgie. And now like these contributors actually have their own NFTs, which is just another great facet of how this all works.
Yeah, we're gonna share that around tomorrow. These things they're gonna look sick. So
can't wait.
I can't wait to share that. Yeah, absolutely. Cool. Look, I don't want to hog the stage, but I wanted to share that on Yieldy. Happy to talk about that or anything else you all want to talk about. Okay.
All right. Hey, thanks as always, man. Appreciate it.
Sure. All right. Later.
Cool. So wrapping up into the home stretch here. We have about 5 more minutes. So let's talk about Bancor. Whoever is more familiar with those specific mechanisms, please join me on stage because I think this is really it's a material difference in terms of like what we thought would be the case when we were talking about Bancor rewards. The TLDR is that Bancor is not committing to offering permanent loss protection in this market environment. It looks like the mechanics of their IL protection just don't really work in bear markets, which isn't great. But really curious to get your thoughts and anybody else that's more familiar with Bancor.
Oops, I was muted. Just pulled up Professor McCarthy as well. So yeah, I mean, I'll give my kind of quick high-level understanding of this. So if any of you guys have been following, first of all, Bancor came and explained their impermanent loss protection to us a while ago. And I know some of us had some questions at the time, like how is this really sustainable? Because basically the way that they're protecting against impermanent loss is with their native token. And so if you experience impermanent loss and you withdraw, they basically like sell Bancor tokens either from the treasury or I think I know in V2 at least.
I think they mint them.
They could actually mint them, and it was both. So like if they had available stuff in the treasury, they would cover it. If not, they would mint new tokens just to cover that loss, which is pretty easily gameable basically. And also is just a recipe for a lot of sell pressure on a token. And if you don't have equivalent buy pressure, then that can cause kind of a death spiral because not only are they minting and selling these tokens to cover impermanent loss, but they also offer single-sided staking and or single-sided liquidity providing. And when you provide liquidity single-sidedly, it gets paired with Bancor tokens, which also I think can just be minted to pair with this liquidity. And then as the price goes down of Bancor tokens, now there's more impermanent loss for everyone who's providing liquidity in any of the pools paired with Bancor. So Bancor kind of realized this pretty quickly. I think they launched June 11th, right? Was when they launched the new V3. So it's only been, correct me if I'm wrong there. It might have been a little bit longer.
But it was about a week though.
Yeah, so it's about a week, and then you can see what happened to their token, and they noticed that some big liquidity providers, Three Arrows Capital is one of them, had basically was already withdrawing their liquidity and liquidating all of their Bancor. So they put a proposal up to basically. Actually, I don't even know if they put a proposal up. I think they just kind of took immediate action and then announced that they had taken this action. Is that right, Professor?
Mm-hmm. Yeah, that's my understanding of the history of it. Yeah.
Yep. So they basically let everyone know, hey, in order to keep the protocol afloat and not risk losing all of the deposits into Bancor, because if you guys have ever been in a liquidity pool where the token that you're paired with goes to zero, you'll basically end up with nothing. You'll end up with a huge amount, millions or seemingly infinite amount of this token that's worth nothing, and then none of the other token that you had paired with. So they basically took kind of emergency action to pause the impermanent loss protection, and it's not clear when it's going to come back. I'm actually not sure. I think there's a lot of people that are hoping that maybe once Three Arrows Capital will basically need to withdraw their liquidity without the impermanent loss protection, because they have they're borrowing from other lenders and they need to basically deposit more collateral before they get liquidated. So I think that's a strategy that Bancor has right now. Or I've at least heard speculation around that, and that maybe after Three Arrows Capital comes back, they'll turn it on. But I'm not so sure. Basically, I think we were all a lot of us were skeptical around whether this model is sustainable. It almost sounded kind of too good to be true. It could definitely work in a bull market, I think, but in a bear market, it's a recipe for a death spiral, it seems like. So fortunately, I'm glad, Professor, that the way you wrote this proposal is that even though the proposal passed, it was all up to the TNDC to decide kind of how much we wanted to deposit into how much farming rewards we wanted to deposit into the Bancor liquidity mining program, and how much of the DAO's Fox we wanted to deposit.
Yeah.
Fortunately, we haven't executed any of those yet, and so I think it's up to the TNDC to decide if we want to move forward with that.
Which we are heavily leaning towards not.
Awesome. Makes sense.
So yeah, that's one of those where like it was good that I was sick and I didn't kind of push that through right away. It took a little time off, and kind of that's a lesson too for the future, in terms of I kept on checking it, and there would be like a 40%, for this token or that token, and I'd be like, oh man, like we're losing out on that kind of first mover advantage. But hey, turns out we really lucked out by not incentivizing a bunch more deposits into something without an escape hatch right now, right? So yeah, it looks like they've got like 40% negative debt on their ETH, and 46 on their chain link, and like 9% on the DAI. Like it doesn't look good from the different analyses I've been looking at.
Oh, got it. So right now they basically, are you saying there's like some impermanent loss accrued that they're
sitting on there's a bunch of debt outstanding, and the master vault, they only have 60% of what they say they have in terms of, or what they owe in ETH. They only have 54% in what they say they owe in Link. It's not as terrible in DAI, but yeah, it's I don't expect the situation. I mean, just like as we've seen with Vari, I don't expect the situation to be cleaned up anytime soon.
Yeah, me neither. I'd certainly wish the Bancor community the best and hopefully surviving this and coming back out on top. But it's hard for me to understand how they could do it, especially when like they spent so long building this V3, and really the big value prop was like this impermanent loss protection and single-sided liquidity providing. And it's not clear at this time that that's actually a sustainable model.
Hey guys, question for you. Doesn't Rune and the whole Thor chain provide impermanent loss protection in this, something similar to this? Is that true?
They do. There's a few differences with the way that Thorchain does it. And Thorchain, basically the way that Thorchain was doing it is based on how they were doing it in Bancor V2. So this V3 model, like there's a couple differences. One was that there's no cap, and you could deposit infinite amounts single-sided. And there's no like period. It's like instantly, you get instant and permanent loss protection. Whereas on Thorchain, it's like the 1% per day accrues. And typically when you have so like right now, even in Thorchain, I got a lot of LP positions in Thorchain, but almost none of mine are actually have any coverage, even though I have experienced a ton of impermanent loss. And the reason for that is the emissions and the fees that you generate. Basically, Thorchain will only pay out the impermanent loss protection if you are net negative versus holding, including the fees and the emissions that you've received. And almost always, I guess, once you have like 100% impermanent loss protection, or once you have enough impermanent loss protection, by that time you've actually generated more fees and revenues from the emissions.
Got it. Okay. Cool. Good to know that. Thank you.
Thanks, guys. Yeah, that's a great summary with the dynamics there. One other thing that just as we wrap up here that popped into the stage chat, Hunt was talking about the prospects for selling our success token at a lower range. I believe that's a tricky one because we want to do right by the original investors like Coinbase that bought at a higher price. However, there's also the possibility that we could create a new success token offering. Willie, you've been pretty close to the metal on that one. What are your thoughts with respect to success?
Yeah, down rounds are never fun, and but I'm personally not too concerned. Like I wouldn't consider that a blocker if we wanted to take the existing success tokens that we have and offer them at a lower price to try and raise more stables. I'm sure our previous investors wouldn't necessarily be stoked about it. But on the bright side, we'd be bringing more stables into the DAO treasury, which increases the likelihood that their success tokens will achieve success. So I think it's justifiable. I think that is one of the levers we can pull. But again, it's back to the hedgy thing. It's like, how do we still need to get interest and demand for it, which is easier said than done, but certainly worthwhile if we can. And perhaps that is a good lever for us to pull.
Yeah, that's a great point.
What's the strike price on those? I mean, I know that they're worth something no matter. I guess that's kind of the key, right? They're worth something even if it closes lower than the strike price. So we have to think about what investors think would be the appreciation and how much they would actually be worth at that time. Yeah, there's definitely some conjecture to do there, I guess.
Yeah, that is a good point. The strike price is hard coded at 80 cents at expiration, which is March 1st, 2024. But to your point, Josh, you at least get one Fox. So it's like one Fox plus what right now, what is an option for?
Yeah, right. You always get at least one Fox. That's right. Right.
So real quick, back to the Bancor discussion. So I know we had passed a proposal to fund the next round of liquidity mining rewards. Half of the rewards were going to be allocated to Uniswap V2, the Fox ETH pool, and then up to an equivalent amount was going to be used to fund the Bancor program, and Bancor was going to match them. What are your thoughts on, do we just proceed? I mean, I'm sure, of course, we proceed with the Uniswap V2 farm. Does it make sense to consider trying to get another proposal through before then to allocate more Fox to the Uniswap V2 Fox ETH farm?
Yeah, I think allocate the original amount.
Allocate the original amount.
Yeah, I can start that up today. What does the community think? Is there a better place? If you know of a better place, let us know, and we can take a look at it.
Well, I think we need to start tapering down the rewards if Bancor is available or not. I don't know. In a down market, maybe that's even worse.